Howdy, Jacob here. Today we're looking at Centene Corporation in the healthcare providers and services industry. 40.7 billion market cap on 38 billion enterprise value, founded in 1984. They operate as a healthcare enterprise that provides programs and services to underinsured and uninsured families, commercial organizations, military families in the US. Their growth has been extraordinarily impressive, going from 16.6 billion in revenue in 2014 all the way to 154 billion in 2023. Margins are very low, however, we do see 2 to 2.5% operating margins with about 11% gross margin. So this is reminding me of another company, Cardinal Health, that we just did, where very low margins but very expansive revenue growth. Return on invested capital, also recent history, not looking extraordinary yet, mid-single digits. Balance sheet shows 17, 19, almost $20 billion cash-like products, essentially no debt compared to that, or short-term debt, and then 17 billion long-term debt. So they have enough cash-like products on hand to write off that debt, to where their only interest-bearing debt would really be capital leases. So we're definitely not concerned with that balance sheet. Cash flow statement shows very solid production of cash from operations with increased capital expenditures. So they are growing, reinvesting back into themselves. They're also acquiring businesses, increasing their CapEx. Their use of cash is outside of acquisitions and reinvestments, share repurchases. So not a whole lot of debt pay down, which free cash flow has grown so much that it's not a terrible concern. And they have enough cash on hand to write off that debt. So we're not really concerned with the debt. Their use is really just going to be reinvesting, acquisitions, buying back shares. So to make some assumptions on the business, I do think that growth for this type of company can be pretty expansive. So I probably wouldn't be surprised. I mean, I say pretty much medical trends 7%, pharmacy 9% seems fairly reasonable in a lot of cases on a fairly conservative basis, obviously depending on the groups you're looking for. But here for them, 7% really wouldn't be unreasonable. So my conservative self thinks that that's a reasonable assumption. And then on the margin side, you're looking at an average of 1.4 and 2.8, kind of all over the place, but I'll probably stick with maybe 2 and 2.5. That might be being too conservative on the free cash flow side, but I think I'm still comfortable with that. And then 1% of shares outstanding repurchased would be about $410 million to offset stock-based. Well, that means 2% would be about 900. So a little over $1 billion to buy back 2% of shares. Given their free cash flow historically, I think that's very doable. And then they spend the remaining 50 to 60% of capital allocation to get a 7% return a year on revenue, to get a 2 and 2.5% margin. And then I think it's a very low business. This is similar to what I was seeing again on Cardinal Health, where the growth is pretty good, but the return on invested capital here and return on assets, 1.8, 1.5, 3.3, really not going to be. It's very substantial. So I guess market average, because I think they have better than average possibility for revenue growth, but poorer than average really hitting that bottom line and being able to use the capital that they have to really push growth on the bottom line, which is what I care about. Give me free cash flow all day. And so right now, pretty close. This seems like a similar story again to Cardinal Health. So we'll see whether these hold given what historical P's are saying. But for me right now, it's looking like a decent enough company to hopefully do a deeper dive in shortly. I hope you enjoy the video and have a great rest of your day. Thank you.